If you've never invested a single dollar and the whole thing feels overwhelming, confusing, and honestly a little intimidating, this is the only video you need. By the end of the next 12 minutes, you'll understand why you need to invest, what to actually buy, where to buy it, how much to start with, and how to do all of it without ever losing sleep. No jargon, no assumptions, no pretending you already know things. We're starting from absolute zero and building up piece by piece. So if you've been putting this off because you didn't know where to begin, stay with me, because by the end, you'll have everything you need to make your very first investment with confidence. Let's begin with the most important question. Why invest at all? Why not just save money in the bank? Here's the answer, and it's the thing that changes everything once you understand it. Money sitting in a regular bank account is quietly losing value every year because of inflation. Inflation is the slow rise in the cost of everything over time. If prices rise by 3% a year, but your savings account pays you almost nothing, then every year your money buys a little less than it did before. You're not standing still, you're slowly going backwards. Investing is how you fight back. By putting your money into assets that grow faster than inflation, you don't just preserve your money, you multiply it. That is the entire reason investing exists. To make your money grow faster than the rising cost of living, so your future self is genuinely wealthier, not just holding more numbers that buy less. Now let me show you the single most powerful force in all of investing, the one that makes everything worth it: compound interest. Here's how it works in plain terms. When you invest money and it earns a return, that return gets added to your original amount. The next year, you earn a return on the bigger amount, including on your previous returns. Your money starts earning money, and then those earnings start earning too. It's a snowball rolling downhill, growing faster and faster the longer it rolls. Let me make it concrete. Imagine you invest $100 a month starting at age 25, earning an average of 8% a year. By the time you're 65, you would have personally put in around $48,000. But your account would be worth over $300,000. The difference, more than $250,000, is compounding doing the work. That is why starting early matters so much more than starting big. Time is the most powerful ingredient you have. So what do you actually invest in? Let's clear up the confusing menu, because this is where most beginners freeze. You'll hear about stocks, bonds, funds, and ETFs, so let me translate each one simply. A stock is a tiny slice of ownership in a single company. Buy a share of a company, and you own a microscopic piece of it. The problem for beginners is that betting on individual companies is risky, because any one company can fail. A bond is essentially a loan you give to a government or company that pays you interest, generally safer than stocks, but with lower returns. Now here's the one that matters most for you: a fund. A fund pools money from thousands of people to buy a huge basket of stocks all at once. And an index fund, the specific kind you'll hear me mention again and again, is a fund that simply buys the entire market, or a huge chunk of it, automatically. An ETF is just an index fund you can buy and sell easily throughout the day, like a stock. For almost every beginner, a broad index fund or ETF is the answer, and let me explain exactly why. Here's why the index fund is a beginner's best friend, and honestly, the choice of many sophisticated investors too. When you buy a broad index fund, you're not betting on one company. You're buying a small piece of hundreds or even thousands of companies at once. If a few of them fail, it barely matters, because you own so many others. You get instant diversification, which is the fancy word for not putting all your eggs in one basket. You don't have to research individual companies, you don't have to guess which one wins, and you don't have to time anything. You simply own the whole market and let it grow over time. Historically, a broad market index fund has returned somewhere around 7 to 10% a year on average over long periods, through every crash and recovery. It is boring, it is simple, and it quietly beats the vast majority of professional investors who try to be clever. For a beginner, boring and simple is exactly what you want. Now let's get practical. Where do you actually buy this? This is the step that intimidates people, but it's genuinely simple.
You open an account with a brokerage, which is just a company that lets you buy and sell investments.
There are many reputable low-cost brokerages and many robo-advisors, which are services that pick and manage a simple portfolio for you automatically if you'd rather be completely hands-off. Opening an account today usually takes about 15 minutes on your phone. You'll provide some identification, link your bank account, and that's essentially it. Once it's open, you transfer in some money, search for a broad index fund or ETF, and buy it with a few taps. That's the whole thing. The mechanics that feel so scary from the outside turn out to be about as complicated as setting up any other app on your phone. The hardest part is genuinely just starting. So how much should you start with? Here's the liberating answer. Far less than you think, and the exact amount matters less than the habit. You do not need thousands of dollars to begin. Many funds let you start with very small amounts, and the real goal is to build the routine of investing regularly. The single best approach for a beginner is to invest a fixed amount on a fixed schedule, the same sum every month, automatically, regardless of what the market is doing. This technique quietly removes the biggest problem beginners face, which is trying to guess the perfect moment to invest. When you invest the same amount every month, you automatically buy more when prices are low and less when prices are high, smoothing everything out over time. Set up an automatic monthly transfer, even a small one, and you've beaten the majority of people who are still waiting for the perfect moment that never comes. Now let me save you from the mistakes that trip up nearly every beginner, because avoiding these matters as much as any single decision you'll make. The first mistake is trying to time the market, waiting for the perfect moment to buy. Nobody can reliably do this, not even the professionals, so don't try. Time in the market beats timing the market. The second mistake is panic selling when the market drops. When your investments fall, and they will, the instinct is to sell to stop the pain. But selling during a dip just turns a temporary paper loss into a permanent real one. The people who succeed hold on and keep buying. The third mistake is chasing hot tips, the meme stock, the crypto your friend swears by, the thing promising to double overnight. If it sounds too good to be true, it is. And the fourth mistake is simply never starting, waiting until you understand everything perfectly, which never happens. You learn by beginning, not before. Let me be completely honest with you about the risks, because you deserve the truth, not a sales pitch. Investing carries real risk. The value of your investments will go down sometimes, occasionally by a lot, and there will be periods where your account is worth less than what you put in. That is not a sign anything is broken. It's simply how markets work in the short term. What history strongly suggests, though, is that a diversified, low-cost portfolio, held patiently over many years and fed consistently, has rewarded investors far more than leaving money in cash ever could. The key words are diversified, patient, and long-term. Never invest money you'll need in the next few years, because you don't want to be forced to sell during a dip. Keep a separate emergency fund in cash for that. And understand that no return is ever guaranteed. This is a long game, and the people who win are simply the ones who start early, stay diversified, and refuse to panic. So let me pull the entire guide together into your first steps. Understand that you invest to beat inflation and harness compounding. Know that for almost every beginner, a broad, low-cost index fund is the simplest, powerful choice. Open a brokerage account, which takes about 15 minutes. Start with whatever amount you can, and automate a fixed monthly contribution so it happens without willpower. Avoid the classic mistakes. Don't time the market, don't panic sell, don't chase hot tips, and above all, don't wait. You now know more than most people ever learn about investing, and certainly enough to begin. The only thing left is to actually take the first step, and the best time to take it is today. So tell me honestly in the comments, have you made your first investment yet? Or is this the video that finally gets you started? And if something still feels unclear, ask me right there. I read every comment and I'll pin the best questions with answers. And once you've started, the next video you want is my complete roadmap from zero to your first $100,000, because that's where this journey leads.